So welcome back to another video, guys. In this particular video, I'll show you how to grow your trading account quickly. So this is actually the second part of how to get rich from stocks. The first part I've already listed in the comment section below. In this particular part, I'll be covering up some important technical data points that you require to grow your account quickly, along with how you need to think in terms of compounding your money. The first thing I'll tell you is that institutions always take time to build positions. See, as a retail trader, you've been told that whenever the breakout happens, you need to get in early in order to capture the entire trend in motion. But it is exactly the opposite that you should do. Initially, you should be in a role of a tortoise. That is, whenever the breakout happens, suppose the breakout is happening here, enter some quantities here, but give time for trend to mature. There will be a pullback in the trend, and this is where you need to then go forward and add positions. Again, if you see a breakout, this is where you need to add positions before the move happens. And this is something I've explained in a lot of my free videos, and especially if you're a community member, this is what I teach you in an established trend, how you need to identify proper pullback structures, and then you need to take those trades. This is one of the key points that I'll tell you that is required in order to grow a small trading account, because this is where risk reward is in your favor and you won't be chasing momentum blindly. So keep this in mind and always take a note of this point that institutions build positions over a period of time, and you have to adopt a role of a tortoise initially when you're starting to buy into an ongoing trend. The second important point in terms of growing a small account is to make use of a market crash. See, when the market crash happens, fear is an emotion that dominates every trader. This is because your fellow traders are posting targets on the downside. You see a lot of negative news flow, but this actually is a huge opportunity that market is giving you. In this particular cycle, you need to adopt a role of a rabbit and you need to grab all the carrots that the market is giving you. You don't have to go ahead and buy everything at once. You can do something like SIP, that is systematic investment plan, and make use of buying companies here, large cap companies, maybe mid cap, small cap, good companies that are available at 30, 40, 50% discount. Because this is where market is skewed on the downside, and your potential to profit and to grow your account is actually maximum in this particular range. You got to make use of market crash. Don't get fearful because of the news flow. This is something that happens every 5 to 6 years, and in between you'll get plenty of opportunities that are even 15 to 20% sort of corrections that you get. So the next time you see a correction, have a list of stocks ready and start buying them slowly. Look into systematic investment plan. This is a huge tool in your favor that will lead to a lot of potential account growth in years to come. So before we move forward, please note that there are over 200 free videos available on this channel for you to learn trading and investing. Just go to the link here. I'll make sure the link is easily visible. Also, when you click on the playlist, each and every video has been organized in a playlist so that you can learn in a proper sequence, take notes, and get better at trading and investing. And make sure you have clicked the subscribe button and the bell icon. This is the only way you will get notified when a new video is released on this channel. And if you think our videos deliver value to you, please consider hitting the like button because it really helps out our channel. Now, the third important point in terms of growing a small trading account is to set your portfolio preference beforehand and to take it step by step, especially if you're a beginner. Now, what I recommend is that if you're a beginner in the market, first start with large cap stocks. Large cap stocks are safe to trade and invest. And in this cycle, you will understand a lot about trend and the importance of volatility. When it comes to the second year, you need to then start focusing on good quality mid caps also, because by then you would have developed solid understanding about price action, volatility, and volume analysis. This is actually vital in terms of trend trading, that is longer form of trading and investing. So this stage is very important. And by the time you reach year 3, this is where you can start handling small cap stocks and micro cap stocks, because by then you will have understood a lot about market cycles, position sizing, and risk management. And once you cross the 3-year benchmark, which is actually a minimum period that is required for a beginner to understand various cycles in the market, then you can adopt a balanced portfolio approach where you will be creating a mix of large cap, mid cap, and small cap stocks. I'll be telling you a few things about how I allocate money with respect to large cap, mid cap, and small cap stocks in the later section of the video. But keep this point in mind because this will give you experience in the market and will gradually move you to the next phase that is important in terms of growing a small account in the market. Now, the fourth important point in terms of growing a small account is learning the importance of less stress as a trader and investor. And I've repeated this many times that you need to get rid of all short term trading data, no open interest, no option chain analysis. All of those things are useless when it comes to growing a small account in the market. You'll simply divert towards futures and options and you'll end up blowing up your entire account. You also need to practice to stay away from news, politics, social media, WhatsApp, Telegram, all those sort of things that will lead to distraction. There are only two things that you need to focus upon. Number one, what is the direction of long term trend? And number two, how you need to trade pullbacks within an ongoing trend. These are the only 2 points that you require in order to grow small trading account from a technical analysis perspective. So all of your analysis, all of your hard work has to be with respect to these 2 points only. Now, don't underestimate what I've just told you. Stress will not only affect your own personal life, but it will have a huge impact on your trading and investing account. So get into a habit of leading a peaceful life. By taking stress and looking at short-term data, you just won't grow in the market. Now, the fifth important point to grow your small trading account is to learn proper allocation in the stock market. Let me just explain what I do. Now, when it comes to me, 50% of my money goes into long-term trading and investing, and I first begin with sectors. Again, if you're a free member of this channel or a community member, you know that my first step of analysis is to always begin with sectors. And I usually pick out the right sectors that are going to move in the market. It is nothing but practice, but it takes some period of time to develop this skill. So when it comes to my entire allocation, let's say I have only 100 rupees to allocate in the market, 50 directly goes to long-term trading, long-term investing, and mainly here I'm taking sector bets in the market. When it comes to stocks, this is where I get into mid-cap and small-cap segments, and this is where I trade those stocks which usually don't belong to the index, and this does give a boost to your overall trading account because your money only grows over a period of time when you're either into large cap, mid cap, or let's say even a small cap space. So 40% of my money again goes into longer form of trading when it comes to mid cap and small cap space. Now only 10% of my money goes into something like short term and swing trading, and rest of it always goes into longer form of trading and investing. Now what retail traders or beginners usually do is that in short term and swing trading, they allocate 90% of their capital and they allocate just 10% or let's say 0% capital in longer form of trading or investing. This is again a huge mistake in the market. Majority of your money has to be in longer form of trading or investment because that is when your account will grow over a period of time. If 90% of your money is only in short term and swing trading accounts, then you will periodically make some money, but in the end, your account just won't grow. This is the truth in the market, and only experience teaches you this. For those of you who are channel members, please note that the strongest sectors and stocks update will be coming out in the community section this week. Please keep your notifications on. And positional trading episode 11 updates also will be coming out on Sunday. In this section, I'm explaining a lot of things about positional trading and how to create long-term systematic trading plans. Channel members, please be active in the community section because this is where I explain a lot of things about practical application of price and volume analysis. And I also teach you how to identify strongest sectors and stocks in the market as the market cycle evolves. So for those of you who are not channel members, you can just join channel membership for 1 month, watch all the 60 plus videos and then cancel your membership. Do not forget to read the updates in the community section because this is where I update about the changing market cycle, strongest sectors and strongest stocks in the market. Now the sixth important step in growing a small trading account is to always take note of the 200-day moving average. This is the ultimate trend indicator. Do not ignore this. There are 3 things that 200 DMA will help you with. Number 1, it will help you identify long-term trend. Number 2, it will help you prevent some financial disasters that you will make in the market. And number 3, it will help you time the market. When it comes to long-term trend, whenever the price is above 200-day moving average, just pause the video and read everything I've written here. This is very important. So whenever the price is above the 200-day moving average, it means the long-term trend is up. And do not think about short selling. This is a huge mistake and will take you years behind when it comes to your overall account growth. So learn to believe in the 200-day moving average. A lot of people say this does not work, but it is mainly because they have not done their homework. So 200 DMA is the ultimate truth when it comes to trend trading. Always trust this. The second important point is about financial disasters. Now let me tell you, if you go back and check your trading journal, you'll find you have bought so many stocks that were below 200-day moving average. This is nothing but a making of a massive financial disaster for you. Always avoid this. Remember, even someone like Paul Tudor Jones, who's a billionaire trader and investor, always believes in 200 DMA. So who are you and I to question this? So stop believing in all the nonsense that goes on in a lot of mediums where 200 DMA is criticized. This is the ultimate trend indicator, and I always begin here when it comes to sector or stock analysis. The third important point is that it is always told that you cannot time the market. 200 DMA again will help you here. If you just plot 200 DMA on sectors and stocks, you will realize that there are some key points that this indicator identifies when it comes to timing the market, and it is entirely possible. So pay attention to 200 DMA. This will save you many a times, and this is one of the main indicators that will help you to grow a small trading account in the market. Now, the seventh important point here is to identify a correction and differentiate it from a crash. Now, the moment market falls 3% or more, you'll start hearing the word crash quite often. This is the biggest trap for a beginner trader investor who has just 0 to 2 years of experience, because every correction, remember, is not a crash in the market. Every correction actually is an opportunity to go long in the market, and this is how you should think. I've covered this concept in many free videos, and even if you're a community member, I always teach you how to handle correction in the market. These are just shakeout patterns that develop on a consistent basis, and once you learn how to identify this is when your account will start growing exponentially. There's just an obsession with this word. Whenever market falls 3-4%, you'll see this word crash floating around on all mediums. Avoid this trap and pay attention from now on that every correction is not a crash. In fact, it is an opportunity to go long in the market. Now, the eighth important point in growing a small trading account is to understand the risk reward cycle. Now, pay attention here. This is very important. In the last video, I've already told you that these are the 4 stages in the market. This is accumulation, this is markup, this is distribution, and this is markdown phase. Now, what typically happens is that at the beginning of the cycle, a retail trader investor, mostly a beginner trader, does not take maximum risk. He's too conservative and he waits for the entire cycle to play out. And this is where he starts taking a lot of positions, especially in the futures and options market. And then the down cycle begins. So this is where he loses most of his capital. As you gain experience in the market, when the price is moving into a markup phase, stage 2 structure, this is where you should be taking maximum risk. Because a lot of people are scared here, fear is gripping in the market, and people just don't take positions. And this is where you need to ride the entire trend with the positions you have taken. As the cycle matures, you need to adjust the risk. This is where, when the distribution happens in the market, you need to have minimum risk. The markdown phase, where price starts moving lower, this is where you need to learn to sit out. I cannot tell you the importance of this risk reward cycle when it comes to growing a small trading account. This is something I've followed consistently over the years and has given me amazing results. You have to identify when the stage 2 is beginning in the market, that is a markup phase, and this is where you need to take risk based on your account size. Now, the next important point with respect to growing a small trading account is to learn to identify which asset class you need to target in which phase. So when the price is in the markup phase, where price is heading higher, you need to be in stocks, because this is where the returns are higher and stocks can do amazing things for your trading account. But when the overall cycle turns bearish and stocks start heading lower, this is where you need to switch to something like fixed return instruments, fixed deposits, savings account, liquid Bs, recurring deposits. These are the instruments that you need to use in stage 4, that is markdown phase. You can also look into gold, because usually when the equity markets don't do well, it is gold that moves higher. And this is where you can earn extra return on your trading account. So when it comes to understanding the asset allocation, pay attention here. In the accumulation phase, this is when you need to get into equities, because when the stage 2 starts in the market, you should be fully invested in your trading and investment account to take benefit of the entire trend cycle. As you gain experience, you can use equities and even FNO to make use of a phase where price simply trends higher. You need to be watchful of the distribution phase, because this is where you need to go into profit protection mode and zero leverage in the market. I cannot tell you how many people lose money here, because by the time the bull market is maturing, a lot of new people get into the market and they move towards FNO and lose a lot of money. And in the 4th stage, when the price is moving lower, be watchful about your asset allocation, because you can protect your money from ETF, fixed deposits, recurring deposits, and even something like gold. If you're a seasoned trader investor, if you become over a period of time, you can also short sell in this phase using futures and options to maximize your risk and reward. So there are three things that you have to understand when you want to grow a small trading account. Number one, your initial capital will matter. The second important point you need to understand is that in order to reap the benefits of compounding, your monthly contribution back to your trading account will also matter a lot. Therefore, keep getting better at what you do in terms of job, save more money, and keep adding back to the initial capital. This is when compounding will start working big time in your favor and your growth will be a lot more faster. The third important point is in terms of mindset. Always understand that long-term trend is the ultimate truth in the market and you need to believe in this. And stop looking at every market correction as a crash. See this as an opportunity and use this to grow your account further. So essentially, growing a small account is a combination of what I taught you here and what I covered in this first part where I explained a lot of things about personal finance. What I'll recommend now is that head back to this video again, watch it, and then come back to the current video and watch this entire video again. These two parts will actually help you think in the right direction and will shorten up your learning curve to a large extent. Kindly consider hitting the like button and sharing this video if you find the content useful. Have a great weekend ahead, guys. Take care and be safe.